Aseem Thakkar, sir. Before that, I would request one and all to please keep silent as we begin with the brain trust session. I request each one of you to kindly put your cell phones on switch off mode or the silent mode. Thank you so much. Sir has been the managing partner of A.L. Thakkar and Company, Chartered Accountants, and a former Vice President, Income Tax Appellate Bar Association, Ahmedabad. Sir is also the author of the digest Income Tax Appellate Tribunal Decisions, Ahmedabad Bench. Sir, we are privileged to have you here today. Please give them a big round of applause, ladies and gentlemen. Let me now brief you all about CA Mehul Thakkar. Sir is a fellow member of ICAI, having 25 plus years of experience as expertise in the field of direct tax, author of comprehensive book on direct tax law and international taxation. Sir has also been a keynote speaker at various branches of ICAI and ICSI and other associations across Gujarat. Sir, we welcome you to the conclave. Let me now brief you all about CA Hiren Shah, sir. Sir has a number of degrees to his credit, from MCom, LLB to CA, PG Diploma, IPR, DITL, a post-graduation program by ICAI, where very few candidates got qualified, and a certified course, IICA, by Ministry of Corporate Affairs. Sir is a partner in MS Dinesh R. Shah and Company with professional experience of 28 years. Sir has contributed articles in various professional journals and has hosted TV programs too. Sir, we are honored to have you here today. Now I would like to take this opportunity to introduce Advocate Mehul Patel, sir. Sir has been practicing as an advocate since 30 years. He was elected as the youngest president of the ITAT Bar Association, Ahmedabad, for the years 2007 to 2009. Sir has also been a speaker faculty at various seminars and lecture meetings organized by various professional associations. Sir, we heartily welcome you to the Tax Conclave 2023. I would now move on to introduce CA Mitish Modi, sir. A chartered accountant by profession, sir is the founder and proprietor of Mitish S. Modi and Company. Sir practices in the area of taxation matters, regularly appearing before the income tax appellate tribunals. So we are honored to have you here amongst us. I would now request to welcome all the dignitaries on the dais with a memento and book. Dr. Advocate Hiren Shah, sir, please come forward to welcome CA Aseem Thakkar, sir. A big round of applause, ladies and gentlemen. I request Dr. Advocate Kartikeya Shah, sir, to come ahead and welcome CA Mehul Thakkar, sir. CA Vishwesh Shah, sir, to welcome CA Hiren Shah, sir. Advocate Ashutosh Thakkar, sir, to welcome Advocate Mehul Patel, sir. and CA Ravi Shah sir to welcome CA Mitish Modi sir. A big thank you to all on the dais. We now open the floor for the question and answer session.
The first poser is allotted to me, so I will straight away begin with the discussion without wasting any more time. Briefly, the poser is that if a 143(3) scrutiny assessment order has been passed after issuance of notice under section 143(2) on a particular issue, say for example in this poser it is mentioned that the issue was regarding the verification of difference in the value of sales as shown in the profit and loss account and the gross value of services for the purpose of service tax. And after that, after accepting the assessor's explanation, the assessing officer has not made any addition. Thereafter, the principal CIT is taking action under section 263 of the Act for revising the order, particularly by relying on explanation 2 to section 263 and setting aside the order by saying that the AO has not made the necessary inquiries and verification. Now, is this justified? Friends, let me tell you first of all that each poser, not only mine, but I am sure the posers allotted to my colleagues over here, firstly, they will all depend on the facts of each case. So we have to first see as to what is the fact of a particular case before applying any particular case law or any particular judgment. So as far as this judgment is concerned, friends, first of all, let us see the explanation 2. I believe the whole problem of 263 recently has arisen only because of this explanation 2, because the language is so wide and so ambiguous in my humble opinion that it is capable of any interpretation. Because explanation 2, particularly the first part, says that the order shall be deemed to be erroneous and prejudicial to the interest of revenue if the order is made without making inquiry or verification which should have been made. Now, what is the inquiry or verification which should have been made is a very, very subjective matter. It would vary from case to case, from officer to officer. So that is why I said that we will have to see each case. But generally we find that the commissioners tend to say that verification is not done, so I set aside, you make the verification and pass a new order. And our experience shows that once CIT says, then in effect giving order invariably addition is made by the AO. Hardly we will come across less than 1% cases where addition is not made in the effect giving order. So friends, here in such circumstances, we can take assistance of 2 or 3 very good case law which has thrown light onto what is the ambit of explanation 2. A recent judgment of Rajkot Tribunal in the case of Pramukh Realty, ITA number 93, Rajkot, 2022, dated 30th June 2022, wherein in a similar situation, when the order was sought to be set aside, the honorable members of Rajkot Tribunal, who are sitting at Ahmedabad only, so we can say it's a jurisdictional tribunal judgment, they beautifully analyzed explanation 2, and this is what they say in the judgment, that as far as the adequacy of inquiry is concerned, there is no law which provides the extent of inquiries to be made by the AO. It is the assessing officer's prerogative to make inquiry to the extent he feels proper. The Commissioner of Income Tax, by invoking revisionary power under section 263, cannot impose his own understanding of the extent of inquiry. So all that is required to be shown is that the view taken by the AO is a plausible view. It is not against the law and it is not against the judgment of a jurisdictional high court. If that be so, then it cannot be termed as erroneous even by taking recourse to explanation 2. Further, they have relied on a beautiful Mumbai tribunal judgment which is inside this judgment only. So I am not giving the citation over here. But this is what the Mumbai tribunal says, that in our considered view, what is relevant for clause A of explanation 2 to section 263 is whether the AO has passed the order after carrying out inquiries or verification which a reasonable and prudent officer would have carried out or not. It does not authorize or give unfettered powers to the learned principal CIT to revise each and every order if, in his opinion, the same has been passed without making inquiries or verification which should have been made. In our view, it is the responsibility of the commissioner to show that the inquiries or verification conducted by the AO was not in accordance with the inquiries or verification that would have been carried out by a prudent officer. And the Punjab and Haryana High Court, friends, has gone one step further, which I would like to point out over here. The Punjab and Haryana is 2022-141 taxman.com, page 83. The case of PCIT versus Kanin, India. Here they say that whether before reaching a conclusion that the order of the AO is erroneous and prejudicial to the interest of revenue, the revisionary authority itself has to undertake some inquiries to establish that the assessment order is erroneous and prejudicial to the interest of revenue, held yes. And the principal CIT was not in a position to point out as to what inquiries or verification should have been made, but had not been made by the AO, so as to make the present case fall within explanation 2 to section 263. So there they went one step further by saying that the commissioner has to indicate as to what are the nature of inquiries or verification that has to be done and how the order is erroneous. Simply set aside by explanation 2 is not valid. Otherwise, friends, the logic is very simple. Otherwise, no scrutiny order would become final. Any and every order is amenable to 263, which would result in endless litigation. That's all. Thank you.
The question is that a search has taken place on a particular date, and in the search proceedings, no incriminating material or other records have been found, including jewelry and valuables. Subsequently, at a later stage, a statement under section 132(4) has been recorded, wherein a disclosure has been made. The SSE has not honored the disclosure, and the AO wants to make additions on the basis of the 132(4) statement recorded. Now, before we begin, let us understand what a 132(4) statement is. Any statement which has been recorded during the currency of the search, before the search gets over, formally by the drawing of the last Panchnama, is the statement recorded under section 132(4). It's a sworn statement. 132(4) in plain simplistic meaning is that an authorized officer is entitled and empowered to record a statement which he may not. If any valuables, money, bullion, jewelry, books of accounts, or any other such evidences have been found, and this statement which is so recorded can be used against him in any proceedings under the Act. There is a further explanation to that also. So the issue probably has arisen on account of the fact that if nothing incriminating has been found, and still whether a statement under section 132(4) can be recorded. Now, even if such a statement is recorded, whether the same would have an evidentiary value so as to fasten me with the tax liability because I have made an admission earlier. There is a very direct decision on this, Naresh Kumar Agarwal, 369 ITR 171 Telangana, where the Telangana court held, in this case what had happened was that there was a search which had taken place. Nearly 3 months down the line, they took a statement which has been stated to be under section 132(4). In all probability, that statement after 3 months would be only on account of some bank locker having been not operated at that point of time. So probably to close the search, that bank locker might have been kept open. So thereafter, statement final was recorded. Now, in spite of no incriminating material had been found, he made a voluntary disclosure of 15 lakhs. And thereafter, the statement came to be closed. While filing the return of income, he did not include this amount of 15 lakhs. the AO said that no, you have made a disclosure in 132.4 and you have to honor it, and therefore, in spite of no material having been found, he made this addition of 15 lakhs and fastened him with a tax liability. CIT appeal did not concur with the view of the SSE, stating that no, this is not rightly done. Tribunal took the decision in favor, and the matter traveled to the High Court, where the High Court has also concurred with the view of the tribunal. What the High Court said was that first and foremost, 132.4 statement can be recorded only if something incriminating has been found. It is not necessary that you have to file a statement. Now, if nothing has been found and if you still record a statement and fasten him with a disclosure on the basis of the admission made, that statement by itself does not have any evidentiary value. So on this basis, the matter has been decided. But I would exercise a word of caution here. Kerala High Court has taken a completely diametrically opposite view. In the case of T.O. Abdul Razak 350 ITR 71. In this case, what had happened was very simply that during the course of search proceedings, purchase agreements were found. There was no finding of any unaccounted payments made vis-a-vis these purchase agreements of properties. These were confronted to the SSE, and the SSE himself voluntarily said that I have made on-money payments for the purchase of this land. The matter traveled. He again did not honor the disclosure, stating that no corroborative material had been found. It was only my bald statement on the basis of which a disclosure has been made, and there is no corroborative evidence found, and it is for the duty of the revenue to prove that I have made such investments, even though I may have said so. Kerala High Court has not agreed with the SSE. Kerala High Court has said that if you have made a statement, it is a fair piece of evidence, it's a good evidence. Now, if you do not want to rely upon this statement, you have to bring something more on record by demonstrating that this disclosure made was either under force or coercion, or there is some misunderstanding of facts. Merely by stating that this is a retractable statement and mere retraction without bringing any evidence on record will not suffice. Even the Supreme Court of late has been taking this kind of view. Bandalal Jat Constructions Private Limited, 264 Taxman 5 Supreme Court. Here also the SSE had made a disclosure. Thereafter he retracted. Supreme Court said that no, this is not permissible. You have made a disclosure. You have to establish that this disclosure made by you in the statement was wrong. Merely stating that this is a wrong disclosure made by itself cannot be the reason for not fastening this tax liability on you. So friends, a word of caution here, that if you want to make a retraction, please ensure that it is made as early as possible and file that retraction before the concerned authorities. Because the prevalent judicial view is that if you do not file any retraction within reasonable time, then this is only an afterthought. So with this background, I would advise that in case of a retraction, it has to be made well in advance so that the department also has a chance to counter whatever you have made.
Serial number 3. Serial number 3, there are, in this case, Mohan had filed the return under 139(3) to carry forward the loss of rupees 20 lakh under the head business or profession. So here return has been filed in time, and return is return of loss rupees 20 lakh. Now he would like to disclose additional business income in the updated return. So here the poser or query go around section 139, newly inserted section, subsection 8A, which is, in this case, he would like to offer additional business income, and he is seeking our advice that whether he can file updated in various following alternatives. Now if you look at the first alternative, original return is a return of loss 20 lakh, and he would like to offer additional business income of rupees 8 lakh. So can he file updated return or not? If I read first proviso to section 139, subsection 8A, first proviso says that provision of this subsection, that is provision of updated return, shall not apply if updated return itself is a return of loss. So if we read first proviso, then there is a categorical restriction on that you cannot file that return. Even fourth proviso, which is very interesting, that means we have to see both. Fourth proviso says that, provided also that if any person had sustained a loss in any previous year, and has furnished a return of loss in a prescribed form within the time allowed under subsection 1 and verified in a prescribed manner containing such other particulars as may be prescribed, then he will be allowed to furnish an update return where such update return is a return of income. The fourth proviso also says, fourth proviso casts twin condition. First condition is that return of loss must have been filed in time. And second, that whatever update return you would like to file, that update return shall be return of income. So if we read first and fourth, both proviso put together, then idea is that under updated return, you must offer positive income. So if you look at point number A, minus 20 lakh plus 8 lakh, still he is in a loss, so he cannot take advantage of new section 139, subsection 8, he cannot file update return. Now if you look at second, in second he would like to offer 25 lakh. The loss is 20 lakh and he will offer 25 lakh additional income. Resultant income would be a positive income. Then he can surely file update return. Third is again very interesting. Third says that he would like to offer exactly 20 lakh. That means loss carry forward was 20 and he would like to offer additional income 20, meaning thereby income offered to taxation is nil income. Now in this case, I'll read clause B of first proviso. What clause B says, if that return has an effect of decreasing total tax liability determined on the basis of return furnished under subsection 1, subsection 4 or subsection 5. Meaning thereby if you have filed original return or a belated return or a revised return, whatever tax liability you have offered, and by filing updated return, you would like to go for decreasing tax liability, means downward tax calculation, then that is not allowed. Now if you look at this third scenario, original return is filed of loss, that means you have not offered any tax liability. By making addition of 20 lakh, again income is nil, tax liability remains nil, that means there is no decrease in tax liability. Practically tax liability remains same. But there is one very interesting clause was inserted under section 139.9. We are all aware that 139.9 is a provision relating to defective return. And defective return, we have got an explanation to that section which lists down the various documents to be attached, various information need to be furnished in the return, otherwise return will be treated as defective. In that, clause CA was introduced by Finance Act 2022 and which says that updated returns shall be accompanied by a proof of tax under section 140B. Now we all are aware that when updated return is required to be filed, you have to pay additional tax under 140B. Now in this case, no additional tax is coming. That means there is no question of paying additional tax under 140B. And if you do not pay 140B, looking to their language employed, return is treated as defective. That means you cannot submit return. So it is my view that in point number C, there is no possibility that you can file update return. If you will file it, they may reject it by giving a notice under 139.9, quoting clause number CA. Thank you.
I'll be more comfortable on podium. Yeah, the case study is all related to the payment to non-resident. The case studies which are allotted to me, they are all related to the taxation on non-resident and also transfer pricing. Now friends, first of all, let me congratulate to the management committee, both the organization for arranging such an excellent conference, Conclave. So I must congratulate to the office bearer, and I'm thankful to the office bearer for giving me an opportunity to share the dais with such a dignitaries, my friends, and they are the dignitaries also. So thank you, office bearer, for giving me an opportunity. Friends, this poser is all related to the NRI who bought the property way back. It was a land which was purchased by a non-resident Indian, and then his residential status is US citizen. Now he bought the land way back in the year 1982, and now he is planning to sell the property, the land. Subject matter of the property is a land which is planning to sell to the Indian resident. So therefore, an issue arises how to address the taxability and what are the relevant provisions for TDS and how one should really address the poser. I can jump to the answer in 1 minute, but let's understand the basic, how one should really evaluate the poser. First of all, any payment made to non-resident will be governed by section 195. So 194 sections, chapter 17B, they are applicable to the resident, whereas section 195 will be applicable to the non-resident. Now, if you read the opening line of the 195, what it says, any sum which is chargeable to tax. Hold on. I'm repeating, any sum which is chargeable to tax. So then, if it is chargeable to tax, then accordingly TDS has to be deducted. Mind well, friends, under 195, there are no threshold exemptions. It applies from rupee number 1. Unlike 194, under 195, there are no threshold exemption. It applies from rupee number 1. Now, friends, with the opening word, sum chargeable to tax. So, which will take me to section 4, section 5, and section 9. To determine the chargeability, I'll have to refer section 4, section 5, section 9. Going through those sections, which will determine ultimately a sum which is paid by resident to non-resident is chargeable to tax. When I say chargeability, it is chargeable in the hands of the non-resident friends. So here, when we talk about the capital gain arising out of the selling of the immovable property, I'll have to go to section 4, 5, 2, read together section 9, and then I will come to know that this sum is chargeable to tax. Fair enough. Then what is the next step? How should I really move forward? Then it will take me to do chapter, to section 112, section 115. It is called the special rate tax. And for each type of the transactions, there are different tax rates. They are inbuilt under the section itself. For example, if it's payment for royalty, payment for fees of technical services, then rate is given 10%. Likewise, there are several payments, there are several TDS rates are given, and I have to really go to the section 115 to determine the rate of the tax. Under this poser, the rate of the tax is given under section 112, subsection 1, subclause C. Non-resident tax rate is 20%. So I know that this sum is chargeable because the subject matter of the asset is located in India. Because prior to explanation 5 and 6, there was some debate which I will be touching upon later. So again, that 20% rate I could really figure out. That 20% rate, a buyer is supposed to deduct TDS at rate of 20%. But mind well, the buyer would deduct 20% on the gross sum. There are no threshold exemption. So under this example, the 5 crore is a sale proceed. And buyer will be deducting 20% on 5 crore, which will be different, will be huge. Then how do I get the remedy? What is the remedy? Where should I go and where should I knock the door? Look here. A chartered account service, a certificate from chartered accountant, would it serve the purpose? Answer is no. Answer is given under section 195(2). You go to AO, produce the computation, produce the evidences. Sir, my actual tax liability is going to be this much, not 20%. And then AO will issue the certificate. This is to be done prior to the remittances started. Because under section 195, date of credit or date of payment, whichever is earlier is applicable. So when you are expecting remittances, and again the question would arise, who will be filing 195(2) application? It is recipient who will be filing, who will be making application to AO, and AO after going through the computation will issue the certificate under section 195(2), and then the certificate copies should be delivered, should be given to the buyer, and accordingly buyer would consider that sum as TDS. Now again, going forward again, there is no mention in the poser, but I'm trying to just throw the light on a poser. What would happen when the transaction is between non-resident to non-resident? Supposing this US citizen is selling the land to somebody in US. It is a transaction between non-resident to non-resident. What would be the taxability? the same procedure has to be adopted. Because the situs principle has to be observed, has to be applied. Section 9, because the asset is physically located in India, and therefore Indian jurisdiction has a right to tax on these transactions, and therefore the answer would be the same. Now under this posture, the asset is land, and therefore if I sell the land, I am not entitled for section 54. Chapter B deductions is available to any resident, any individual, and therefore it is not restricting to the resident. It is available to non-resident. When I say chapter 4B, section 54, section 54 EC, section 54 F, they are available to non-resident. But here, the subject matter of the asset is land, and therefore I will not be entitled to get the deduction under section 54 for the flat which he will be buying. He has got an offer that you will be getting one flat, in exchange of this land you will be given some check payments, so that's going to be a consideration breakup. But I will not be entitled to get the section 54 relief, because this is the land, this is not the residential property, because land apparent to residential, the plain land, of course my dear friends can really throw some more light on the litigation, on some judicial interpretation, but if on a plain reading, it is land. Going forward, and therefore what would happen, if he is selling the land, he has to go to section 54F, and therefore it is written under the posture that he doesn't hold any other asset, and therefore 54F is the available section. So 54 EC, 54F, I'm not going to the computation part. I'm just bringing some kind of the points from the posers and throwing the light on the posers or on the, okay. So, and if it is residential property, yes, section 54, 54F, everything is correct. And answer would not be same if it is the residential property, the answer is same. In one line, it is section 195, 195(2), and then we'll have to go to AO, take the certificate and determine the tax liability. Thank you very much.
Good evening to everybody. Now, question number 5. If you read the question number 5, it is very much clear that it is the question relating to the faceless assessment scheme. Precisely the question is the issue arising during the assessment proceeding under the faceless regime, when the assessing officer is demanding for the translated documents in English. When we are submitting the documents, title deeds or purchase deeds or sale deed or the documents from the state government authorities, all these documents are in Gujarati, and the assessing officer is asking for the translated copy in English. And there are certain cases that when the assessee is not submitting the translated copy, the assessment order are passed arbitrarily, raising the huge demand. Now the question is, what is the remedy with the assessee? Is the assessment unit under FS having powers to pass the assessment order on the ground failure on the part of the assessee to submit the documents in English language? No. I just refer the SOP published by the CPDT. Exactly, it is for the National E-Assessment Center. Earlier, all we know that earlier the provisions of that E-assessment scheme was there. Then faceless assessment came into picture. At that time, the central board had issued the SOP. That SOP is dated 19/11/2020. And in para G, under the head, assistance in translation, transcription, etc. We all know that there are 4 duties under this faceless assessment scheme. Assessment unit, verification unit, technical unit, and review unit. Now under para G, it is clarified in this SOP that the AU or VU, that is assessment unit or the verification unit, may seek assistance of designated technical unit for translation of submissions and documents received in AU or VU in vernacular language. Meaning thereby, it is the duty of the assessing officer under the faceless assessment regime to get the documents translated in English whenever the assessee submits on e-portal or the income tax portal the documents, any documents in vernacular language. As a matter of fact, in Gujarat, what I believe, there are no such serious matter, but in South India, there is a serious issue because that language nobody can understand. But they insisted, you go to the technical unit, they are giving in the written submission that to the assessment unit, AO of the assessment unit, that you exercise your powers under this SOP, para G, and you direct the technical unit to get the documents in vernacular language translated into English. One more thing I may highlight, that the CBDT officials in the National Tax Conference, they have clarified when the many questions, many issues put forward before them, and it has been released by the taxman on 2nd October 2020. I read question and the answer given by the CBDT officials. This is very important. How would NESE deal with documents in vernacular languages? It is very common to see several documents, that is title deeds of properties, communications with local and state government authorities, accounts by small businesses are maintained in a vernacular language. Presently, within the territorial jurisdiction, taxpayers are not put through the ordeal of submitting transmissions of such documents, as officers or inspectors are familiar with the vernacular language. On this aspect, it was explained that there are government approved setups which handle the job of converting vernacular languages. Department will deal on its own to convert the vernacular languages, although taxpayers should try to make submissions in understandable languages. So it is very much clear that the burden is upon the assessing officer to get translated the vernacular language documents into the English if he insisted. So when the insistence from the assessment unit to submit the documents in English language, we can refer this SOP, and even if the assessment order pass, it is the pure violation of the principles of natural justice, and we can proceed further under the law. Thank you.
I am taking up question number 6. Basically, it is regarding the claiming of prior period expenses. The SS is a limited company. Some prior period expenses were claimed. In scrutiny, it was allowed. However, the CIT took action under section 263 by saying that the correct income should be taxed of each previous year and the prior year expense is not allowable. So the order is erroneous. Now, what is the defense available? Now, first of all, let me tell you, friends, that all this litigation of taxing of allowability of prior period expense is entirely a futile litigation in a way. It has been held way back in Nagri Mills case 33 ITR by Bombay High Court, that particularly when cases like limited company or an SSE individual where the tax rate is same, it really does not make any difference, barring a few thousand rupees of interest maybe. So such type of litigation should be avoided where genuineness of expense is not doubted. Because normally our experience shows that it is always one-way traffic of the department. Whenever we show prior period income in a later year, they always tax it. But when it comes to allowing expense of an earlier year, they say, no, this belongs to earlier year, so we will not allow it. So in such type of cases, the Gujarat High Court judgment is also there in the case of Adani Enterprise, tax appeal number 566 of 2016, wherein the Honorable Court has held that such type of litigation should be avoided by the revenue, particularly when they are taxing income of a prior year, then why not allow expenses? And it is all revenue neutral. Nobody is gaining because tax rates are same. Now what would happen when 263 is sought to be undertaken in a case like this? That whether a global picture of earlier year and current year can be seen together or not. Now in this circumstance also, we have a recent judgment of Calcutta High Court in the case of Britannia Industries, which is reported in 145taxman.com page 618, Britannia Industries, wherein in a similar situation, the High Court has quashed the 263 order by observing that the tribunal has noted that it is not the case where the expenses were charged as deduction in the preceding year. More importantly, the tribunal noted that there is no revenue implication and no prejudice is caused to the revenue since the tax rate applicable to the SSE during 15-16 and 16-17 was same. So in such circumstances, they held that it cannot be termed as an order prejudicial to the interest of revenue. So 263 was quashed. And friends, I would just like to bring to your kind knowledge a reverse case wherein 263 was sought to be taxed, sought to be undertaken to tax income of a previous year in a later year. There also 263 has been quashed by the tribunal, a very recent decision of tribunal, Surat tribunal, which is ITA number 171, Surat, /2019, order dated 30th January 2023. In the case of Jairam Diyalani, wherein when it was pointed out that the same income is already offered in the earlier year, in fact a larger amount was offered, so there is no prejudice to the interest of revenue when you are saying that in 263 the same income ought to be taxed in a later year. So taking a global view, there also the tribunal said that 263 is not justified because there is no loss to the revenue, there is no prejudice to the revenue. So global picture can be taken into consideration even for 263 proceedings. Thank you.
Question number 7, whether an NRI can be subjected to search proceedings. That is the sum and substance of the question. Now, Section 132 1D states that you can authorize a search or a seizure if there is reason to believe that any person is in possession of any money, jewelry, valuable article or thing, and such money, bullion, jewelry, article or thing either wholly or partly represents any income or property which has either not been disclosed or which is not likely to be disclosed. If such being the circumstances, generally search takes place. So then the issue is that to whom can the search provisions apply, whether a NRI can be subjected to search. Now the word which has been used in section 132 1D is any person. So it may be a super senior, it may be a male, female, firm, company, anybody. There is no distinction or no debarring that an NRI cannot be subjected to search. I have done some research and there is one decision only to this effect which I could find, and that is in the case of Ramkumar Dhanuka versus Union of India, 252 ITR 205 Rajasthan, and in all probability this matter has not even traveled to the Supreme Court. So I think this matter has rested now. Here in this case, the SSC was a citizen of Nepal. He was there, staying there. He was paying his taxes, filing his return in Nepal. There was an income tax search which took place on his family members as well as his business associates. As a result of the search, there was seizure of valuable articles and things, and he did not give any explanation but took the simple plea that I am an NRI and you cannot subject me to search proceedings. Rajasthan High Court has taken a view that no, search proceedings are applicable as per the conditions of section 132 1D, and it does not draw out any distinction between a non-resident and a resident. So therefore, even in case of a non-resident or a citizen, because what they said was that even in case of a non-resident, there are certain incomes which are arising in India, which would be taxable. If he has earned or there is income which is arising or accruing to him in India, he would be taxable to that relative restricted portion. So therefore, he cannot completely excuse himself that no, I cannot be subjected to search. That is the answer. I think Hiren Bhai would throw more light because then everybody would take EB5 and do business here.
I agree with views, because ultimately it is matter, source of income is more concerned rather than your residentials. If you source the income and if you hide the income, the irrespective of your residential status. I will add something here. If you are non-resident, earning income in India, source income in India, it is liable to tax. In the same manner, in the search proceeding, that whole objective or aim is to detect your source income in India, and therefore I think they can definitely undertake the search, and they have every right to verify. Even I've seen many a times if somebody found the dollar currency during the search proceeding also, or some notes or some kind of the Benami notes belonging to non-resident, then they issue the notice as an agent of the non-resident.
Now I am taking up question number 8. In this case, Mr. Shyam suffered a business loss of Rs 4 lakh, wherein the breakup is 3 lakh was on account of unabsorbed depreciation, and balance is a actual business loss of 1 lakh rupee. In addition to above, he has got salary income of Rs 12 lakh for the same financial year, and interestingly on that, tax has not been deducted by the employer. And in this case, Shyam had not filed a return of income for the said previous year. Now, first question is, can he file update return? And second question says that, what will be the treatment of business loss at the time of filing update return? Now, so far as filing of update return is concerned, we have already seen first proviso. First proviso puts a restriction that return should not be return of loss. So in this case, if we make computation, and we are all aware that business losses cannot be set off against salary income. So in this case, the total income would be 12 lakh rupee. So that return would not be a return of loss practically. So in this case, an additional tax would also arise because tax has not been deducted. So in this case, he can definitely file update return under section 139(8)(a). Now, a question may arise, what will be the treatment of business loss? Now, so far as business loss, or so far as losses are concerned, we are aware of section 139(3), which mandates that if you would like to carry forward losses, return has to be furnished in time. So far as 1 lakh business loss is concerned, that you cannot carry forward. But unabsorbed depreciation, if you read section 72 for business loss, but unabsorbed depreciation, it is governed by section 32. So there is no condition that return has to be filed in time for carry forward of unabsorbed depreciation. So in this case, definitely he can carry forward unabsorbed depreciation. Thank you.
The next poser is on the section 6, the test of the residential status. Now the poser goes like this: a US citizen has some source of income from India, and that aggregate income from India is 23 lakhs. Now mind particularly observe one line that Mr. A is a US citizen, and therefore he will be governed by section 6(1), and therefore his stays exceeds 182 days in India, and then in that case Indian source income is liable to be taxed. Assuming that Mr. A is Indian citizen, and then he frequently travels to India, he visits to India, that will take us to explanation 6.1, explanation C. What it says that if he visits to India, and if his stay exceeds 182 days in India, and if his foreign Indian source income is below 15 lakhs, then the number of days would be 182 days. And if the Indian source income is more than 15 lakhs, then the physical stay in India would be more than 120 days. So let me put it this way: a person who is Indian citizen, visit to India, having Indian source of income more than 15 lakh rupees and exceeds stay 120 days, then he will be considered as an Indian resident. Assuming the income is below 15 lakhs, then he will be considered, then we'll have to see 182 days. But the point which is to be noted here, that the income which is chargeable to tax, that is to be seen. The total income, aggregate total income exceeding 15 lakhs. Now under this table, the total income, total income is 23, but the taxable income is 15 lakhs. Because NRE deposit is exempted under section 10, share of profit is exempted under section 10. So if you remove those two items, then his income will be, the Indian source income will be 15 lakh rupees. And therefore, it does not exceed 15 lakh rupees. And therefore, if he crosses his presence in India during the previous year more than 182 days, then he would be considered as resident but not ordinary resident. So because we have to see the final taxable income, and that too final taxable income exceeds 15 lakh. Now with one amendment, there is section 6(1) capital A is inserted. It says that Indian citizen who has Indian source income more than 15 lakhs and who resides in a country where he is not liable to tax, in that case, he will be considered as a deemed resident. That is section 6(1) capital A. Now under the second limb of the process, part B of the process talks about this only. Mind well, the difference between 6 and 6(1) capital A, under 6(1) capital A, there are no physical stay numbers. Even if you stay for a day and your Indian source income is more than 15 lakh rupees, and if you are from a foreign tax jurisdiction where the income earned in the foreign tax jurisdiction is not liable for tax, then you will be considered as deemed resident. Exactly under part B addresses that issue only. That person lives in UAE. Under UAE, there is no individual taxation. And therefore, he has a source of income, assuming that Indian source of income is more than 15 lakhs, and he resides in UAE, where there is no taxation or income is not liable to tax. Liable to tax is a very different term, mind well friends. It is already litigated in the past. So, therefore, if he is from UAE, then he will be considered as deemed resident, and what would be the consequences? The consequences would be the global income will be liable to tax in India. That would be the consequences. So difference between 6 and 6(1) capital A, under 6(1) capital A, there are no physical stay, there are no reference to physical stay in India. So that's the difference. Thank you.
Now the question again is on faceless assessment. The issue about the date of issue of notice. The question is what would be the date of issue of notice when the notice is dated 31st March 2022 or before, but digitally signed on or after 1st April 2022 and served and issued by the SSC concerned on or after 1/4/2022. Now this era of digitally signed documents and the faceless assessment regime, now we have to train ourselves and we have to understand. Because now Information Technology Act is very important and we all have to study. Many a times when the time barring period of issuance of notice is concerned, suppose in looking to this question, the last date of issuance of notice is 31st March 2022. Now on the email, it is shown, it is served upon the SSC on 1st April 2022. Now issue, what is the date of notice issued as per the provisions of the faceless assessment scheme? Because if it is issued and proved that it is issued after the time barring date, the assessment proceedings is going to be time barred. So under the Information Technology Act, there are so many provisions, and one recent judgment on this issue, it is very relevant. 136 taxman.com 4/2/46 Allahabad High Court, Dauji Abhushan Bandar versus Union of India. In this case, the assessing officer is issued the notice dated 31st March, but it has been served after 31st March, and after verification of the records of the department, it is found that the assessing officer of the assessment unit has digitally signed the notice after 31st March. So the court held that the notice, even though dated 31st March, but digitally signed and entered in computer resources, that is the e-portal of the department, after 31st March, the notice is time barred, and therefore the assessment is going to be quashed. This is very important. Many times we have experienced last date we received the notice, and we are not acquainted of these technicalities of the faceless scheme and this Information Technology Act. So we have to learn on this aspect also, and this is very important judgment, and looking to that, this question may be raised by the participants. Thank you very much. Citation 136 taxman.com 246, Allahabad High Court, page 246. Thank you.
The next is question number 11. This is regarding levy of penalty under section 270 capital A of the Act for misreporting of income. Now friends, let me tell you at the outset that as far as this penalty is concerned, under-reporting of income and misreporting of income, still it's a very raw stage and the case law is yet to develop on this, and we'll be facing a huge task when penalties are levied on this count. In this poser, relatively the issue is simple, that the SSC himself had disallowed 5 lakh under section 14A of the Act. However, in the assessment, the assessing officer worked out the disallowance at 8 lakh and added the difference of 3 lakh. Now, whether penalty under section 270A for misreporting is leviable or not. Friends, this is answered directly by Delhi High Court in the case of Prem Brothers Infrastructure LLP, 142taxman.com, page 38, Delhi High Court. Friends, we have to be, I'll just read a portion of the Delhi High Court judgment. In para 7 of the judgment, the Delhi High Court says that this is a case where amount of under-reporting of income is in consequence to increase in the disallowance which was voluntarily made by the SSE. This court is conscious of the fact that there can be cases where under-reporting of income may result in misreporting of income. However, in peculiar facts of the present case, the under-reporting allegedly done by the SSE cannot amount to misreporting, as the SSE has furnished all the details of transactions relating to the disallowance under section 14A, and the AO as well as the SSE has used the same details to arrive at a different conclusion, that is different quantum of disallowance. This by no stretch of imagination can be held to be misreporting. This court also further finds that there is not even a whisper as to which limb of subsection 9 of 270A has been attracted and sought to be used against the SSE. Friends, here only I would like to say that as far as 270A is concerned, if we carefully read the provisions of section, see, if your case falls under under-reporting of income, then penalty is 50% of the tax sought to be evaded. And in under-reporting, in subsection 6, 270A subsection 6, there is an exception that if you are able to show that you have disclosed all the particulars, your accounts are true and correct, and if the addition is on an estimate basis, etc., then penalty is not leviable. So in my respectful submission, in my humble opinion, we can say that all the case law that we have on 271(1)(c) penalty will squarely apply to such type of penalties also, depending on whether the disallowance was of a bona fide claim, whether you have disclosed all the full particulars, facts correctly or not, whether figures in the audit report are not found to be untrue, then whether the disallowance is only because of a difference, bona fide difference of opinion between you and the department. All those case law of 271(1)(c), for example, we have got two superb judgments of 271(1)(c) in the case of Reliance Petro Products, 322 ITR 158, and also Dilip Shroff, 291 ITR page 519. Those principles will squarely apply as far as under-reporting of income is concerned. But friends, the dangerous part is 270A subsection 9, that is misreporting of income. Friends, if your case would fall in misreporting of income, which includes cases of misrepresentation or suppression of facts, failure to record investment, then claim of an expenditure which is wrong, or a false entry in your books of account, etc. If your case falls in this, then you are definitely bound to be in trouble in this new penalty, because apart from difficulty in defending such type of penalty, the quantum of penalty will also be 200% of the tax sought to be of the tax that you have evaded. So friends, as I said, that case law will develop, but then I would only suggest that days have come of voluntary compliance. So friends, please be careful while filing the return of income to see that no hanky-panky claims are made. Otherwise, this penalty is going to create problems. Thank you.
The next is question number 12. Here in this case, the SSC company has filed the return of income under section 139 of say 2 crores. Thereafter, a search has taken place, and in the return filed in 153A in response to the notice, the SSC makes a fresh claim. Whether such fresh claim made in the return filed under section 153A is admissible or not, that is the moot question. Now, we have had 3 regimes of search assessments. The first was 158 BC-BD, where we had block assessment and regular assessment. Then we had in respect of search, which was carried out after 31st of May 2003, we had 153A proceedings, and now for searches after 1/4/2021, we have 148 straight and simple provisions. As supposedly, that is the contention of the government, that these are now simpler. 153A we are dealing with in this subject. In 153A, the provisions are briefly that once you have been subjected to search, the AO will issue a notice for 153A for 6 assessment years preceding the year in which the search took place. Now again there is a bifurcation. Which assessments will be done, which will not be disturbed? And that has been laid down by various judicial pronouncements. So the prevalent judicial view is that in case of completed search, where there is nothing pending, only if incriminating material is found, then you will disturb the assessment, otherwise you will accept the assessment. Saumya Construction, Kabul Chawla, all these are the decisions in favor of this proposition. There are only 2 high courts which have taken a contrary view. One is Allahabad High Court and one is the Kerala High Court. Now the second situation is that the assessments are pending, then these will abate. So what are pending assessments are that where the possibility of a notice has been issued, or where the time limit for issuance of the notice has not elapsed. So in those cases, these will abate and regular assessment will take place, and irrespective of whether incriminating material has been found or not, assessment will be done in the manner in which the officer would like to go ahead and proceed. In this case, the assessment from the apparent dates is that the assessment is not pending, so it will abate. Now if it abates, then he has to pass an order under section 153A, because now there is no multiplicity of proceedings. The SSC can make a claim, and make a claim which he has already not claimed in section 139 return. And this is found favor in the case of JSW Steel 422 ITR 71 Mumbai. But now let us assume a situation where the assessment has already been completed and the assessments are not pending. Whether can I file in response to a 153A notice a return whereby I make a fresh claim in respect of a completed assessment? As you are well aware that if there is no incriminating material, it cannot be disturbed. So therefore, it cannot work to your advantage that if I have an advantage, then you disturb my assessment. That is also not permissible. Jai Steel India, 219 Taxman 223 Rajasthan High Court. But most of the times, there is an error committed by the AO. They say that 153A proceedings are akin to reassessment proceedings. And therefore, we cannot, these 153A proceedings are on account of a search which has been carried out, and these are not for your benefit. And so if they are not for your benefit, you cannot make a fresh claim irrespective of whether the assessment is pending or not. Now, this is not the correct view. The view which has been propounded, this has been taken into consideration. Both the high courts have taken into view that no, these are not akin to reassessment proceedings, and therefore Sun Engineering works that reassessment proceedings are only for the benefit of the revenue and no fresh claims can be made is not the correct proposition of law if it is canvassed by the AO while framing the assessment.
Now I am taking up question number 13. It is also pertinent to updated return. The question I request all of you to read minutely. Discuss the eligibility of filing updated return in the following cases, keeping in mind the restriction imposed by Clause B of third proviso to Section 139, subsection 8A, which reads as under. I am reading that Clause B of third proviso. Provided also that no updated return shall be furnished by any person for the relevant assessment year where any proceeding for assessment, reassessment, recomputation or revision of income under these act is pending or it has been completed for the relevant assessment year in his case. So we are looking at right now the restriction on filing updated return. Now this clause, I think what Aseem bhai was talking about pending. There are two aspects here. It is pending, or second word is it has been completed. So any proceeding has been pending or completed. In that case, you are not eligible to file updated return. Now again, I'll say what Mehul Patel sir said, that Mehul bhai said that this is again a developing law. This is new section, and we will find lots of litigation because there are three cases has been put before me. First is return has been filed for the relevant year, and same has been processed under 143(1) of the Act. First is a case where return has been filed and intimation has been issued. And let us take it for an understanding that there is no scrutiny notice has been given. Now, is it a case of completion of assessment? Can we say that 143(1) is an assessment? Well, that is going to be, if we look at our, I think, observation of Rajesh Javeri, stockbroker, 161 taxman 316, where the observation of Supreme Court was that intimation under 143(1) cannot be considered as an order of assessment. And even earlier, I think it was 264, there was a deemed explanation for revising intimation issued under 143(1). There is a separate explanation was there because it is not an order, it is just a mere intimation under 143(1). So if we take it that view of whatever the observation of Supreme Court right now in this, that intimation is not an assessment. So if it is not an assessment, then we cannot say it is pending or completed. So in that situation, you are eligible to file updated return. Again, I am saying that this is going to develop lots of litigation in future. I am just giving whatever understanding I have on this topic. Case number 2 is return has not been filed here for the relevant assessment year, and the SSC was in receipt of notice under 142(1), requiring him to furnish return within 30 days of receipt of that notice. And interestingly, SSC failed to submit the return even within 30 days. Now we are aware that 142(1) that can be issued whether you have submitted return or not. If you look at the language deployed in this section, then 142(1) notice can be issued even if you have not filed return. And where there is a specific, I think subclause 1, it says that if return has not been filed, EO may give you a notice requiring you to file the return. Now a question here is, we have already seen restriction. Restriction is if proceeding for assessment is pending. If proceeding for assessment is pending or completed, then in that event you cannot file updated return. Now a question may arise that whether 142 subsection 1 proceeding, and more particularly here this proceeding is not in connection with scrutiny, because 142(1) can also be issued along with or in continuation of scrutiny proceedings. First, normally they issue jurisdictional notice under 143(2) within the time frame given under that section, subsection 2, and then they go for detailed inquiry notice under 142(1). So this is not a kind of detailed inquiry. It is not a case of assessment has commenced. It is just a case of that you have not filed return, which came to the notice of Income Tax Department, and they just given you a notice requiring you to file the return. So can we say it is a assessment proceeding pending? In my understanding and my opinion is that it is not an assessment proceeding pending. If you do not file return, there is a possibility that you are violating 142(1). In that situation, they may invoke 144. They may invoke best judgment assessment. For that also, so cause needs to be given. If so cause is received, then you can say that it is a proceeding pending. Otherwise, I don't understand. I am not of the opinion that it cannot be termed as a proceeding pending. Case number 3, taxpayer is in receipt of notice under 148 capital A of the Act. And the section heading of 148A, I have just put it here, that conducting inquiry, providing opportunity before issue of notice under 148. So now we are aware that under new 147 regime, 148A, if we summarize that 148A, so what normally it requires that earlier the case was that we were straight away in receipt of notice under 148 and we were seeking reasons for the reopening and we were filing objection against that as per the Supreme Court decision in case of GK and Drivesaft 2003. But now new proceeding is, they have inbuilt that requirement of Supreme Court judgment. And what 148A provides that before issuing notice under 148, AO shall conduct inquiry if required and he should give an opportunity of being heard. And after considering the SS's reply, AO shall decide whether it is a fit case for issue of notice under section 148 or not. And if it is a fit case, then the duty cast upon him is that along with 148 notice, he should also accompany the order under 148A subclause D. Now, the question is, can 148A proceeding, you have not received till 148 notice requiring you to file the return. So can 148A proceeding will be considered as a proceeding pending for assessment? That would be a question here. Now I refer one judgment because this is again whether assessment is pending or not. There are many, this similar word appears under section 153A regime. In 153 also, like what Aseem was telling, that assessment pending on date of search shall abate. So in that situation, what is pending? So you can refer that judgment of Delhi ITT 72 taxman.com 340. I repeat 72 taxman.com 340. I am reading that particular observation of Delhi Tribunal. I am sorry, it is not Delhi High Court, Delhi Tribunal. That assessment can be said to be pending only if AO is statutorily required to do something further. And where the issue was of 143(1), where the Delhi Tribunal says that once intimation is given, that means return has been considered under 143(1), processing has been done, then there is nothing further required to be done statutorily. Unless notice under 142 had been issued, then AO has to further conduct assessment in accordance with either 143, if SSC complies, doesn't comply, then it would go under 144. So if we take it this view, then here this is an inquiry stage. Assessment actually commences when you are in receipt of notice under 148, whereby AO now assumes jurisdiction under 147. Because if you look at 147, then 148 is mandatory to assume jurisdiction to carry out the assessment under 147. So in my opinion is that till 148 notice is not given to you, that means if proceeding is pending under 148 capital A, one can take a chance of filing update return. But again, this is going to be a very debatable issue in future and we will see many judgments in near future. Thank you.
Yeah, thank you. The poser is on an Indian company who approaches Mr. A, and Mr. A lives in United States. Company A wants to promote the sales in United States and company A has a lot of customers in US. So therefore he approaches Mr. A to promote the business and to provide the support services to the local US clients. Now Mr. A approaches you, the company offered him two options. Either you can have a retainership agreement or you can have an employment. So Mr. A is not clear on the taxability, which options should he really accept and what would be the tax consequences for each of the options. Now the options offered are employment contract or marketing consultant contracts. Now the characterization of transactions or characterization of income goes like this. He will be paid either salary or monthly retainership fees. He will be entitled to reimburse all the expenses. Mr. A requested a company that I will not be claiming, Mr. A said, I will not be going for case to case or actual reimbursement, so kindly consider the request for the ad hoc reimbursement. That is number 2. And number 3 is a sales commission. Now, let us understand the consequences for each of the options. If he is going as an employment contract, then undoubtedly what salary is received is considered as a salary under section 17. the commission what is offered will be also considered as salary. If you go as a characterization of income, then the commission would also be considered as salary. And the third element is the reimbursement. If it is ad hoc reimbursement, then it will be considered also as the perquisites. And therefore, the sum total of these three nature of the transactions would be considered as the salary income. But since Mr. A is non-resident, he will be governed by Section 9. Income accrue or arise in India or deemed to be accrue or arise in India. Now, Section 9(1) Roman 2 deals with the salary characteristics of income. What it says, the salary either paid in India or salary paid for services rendered in India. Now, under this scenario, Mr. A is not paid remuneration salary in India, or he will be rendering services out of India. And therefore, salary income is not liable to tax in India in view of Section 9(1) Roman 2. Going forward, if he is offered marketing consultant, he is offered retainership, he would be acting as a marketing consultant. Now, under the marketing consultant also, he will be paid a monthly fixed remuneration or fixed fees. Now, that marketing consultation would be termed as a fees for technical services. So that will take us to Section 9(1) Roman 7. And Part B of 9(1)(7) says that if the services are rendered out of country, or if the source is out of country, then again the said consultation fee is not liable to tax in India. So it is neither tax under 9(1)(2) as a salary income, nor tax as a fees for technical services under 9(1)(7). Now the last point, just for the sake of discussion, if services are utilized in India, assuming I am on a consultation fee, if services are utilized in India, what would be the scenario? Then it would be 9(1)(7), then it is income which is liable to tax, that is to be taxed in view of Section 115. That is not a debate. But my point is on the ad hoc reimbursement. Then what would be the treatment to the ad hoc reimbursement? Now, on reimbursement of expenses, there are two thoughts. One, reimbursement of expenses, back-to-back reimbursement of expenses, they are not considered as an income because there is no profit element. Of course, there are a couple of decisions are there, but there could be different economic reasons like Danfoss and all this. But then again, by and large, if you see the judicial views, back-to-back reimbursements is not considered as an income. If you consider this as an income, what would be the characterizer of income? It will be considered as a fees for technical services. I am on again reimbursement. But if it is ad hoc reimbursement, then it would be considered as fees for technical services. So that you have to club the element with the retainership fees plus fees for reimbursement. The total will be considered for fees for technical services. If you are covered under the 9(1)(7)(b), that service is utilized out of country or source of income is out of country, then again both the element is not liable to tax. Then going forward with the sales commission, as I say, if you are into employment contract, then commission would be characterized as salary income, but again you go back to 9(1)(2), and therefore that sales commission is a part of salary income, and salary income is not liable for tax because these services are not rendered in India. And if sales commission is, again, you receive sales commission as consultant, then again the sales commission would be considered as a technical services. Then again there are circulars and they are all withdrawn, but again 9(1)(7)(b) comes to your rescue, saying that again services are again not utilized in India because he will be helping to export the business, to promote the export business. He'll be helping companies who are located out of country, and therefore the source of income is going to be out of country, and therefore it is also not liable to tax. Only on marketing consultant, one would face the consequences under the GST, but I'm not into GST practice, but one would may consider reverse charge mechanism of something that one has to analyze on the GST principles. So the answer is same answer for employment contract, marketing contract. Again, on employment contract, there will be some loss on social security payments. Because if you are an employee of a company in India, tax is very clear that there is no taxability. But on the labor laws and on the security payment like PF and all other things, one has to really evaluate. And if you are falling under the scope of the taxability under the labor laws, then one would have to take a call that I would not opt, because again, for your information, even for income tax, we have a tax treaty between India and other countries to eliminate the double taxation. Likewise, for social security payments also, India has a treaty with many countries. So if that country falls under the treaty, then again you will get the setup in the home country, but I'm not going into that nitty-gritty. In one line, that social security obligation as an employer, that is to be examined, and if it is applicable, so that is going to be the additional cost for company. Thank you.
Okay, Hiren bhai. Now the another question is also on faceless regime, precisely the binding nature of the judicial pronouncements. But we are facing this issue also during the faceless assessment proceedings, when we are making submissions and we are requesting the assessment unit that you consider this judgment of the jurisdictional high court. There is no response from the assessment unit and they are passing the order, just conveniently ignoring the judicial pronouncement of the jurisdictional high court. Now, it is very much clear that the faceless assessment scheme means moving from the territorial jurisdiction to the dynamic jurisdiction. Means the assessment at one place can be done by the assessing officer at other places. You all know that there are assessment units under the regional level and there are so many centers. Now this issue is now persistent issue, and there are questions for which we have direct judgment in favor of the SSE. On particular issue, we have direct judgment in favor of the SSE and we are therefore relying upon that judgment, but ignored by the assessment unit. For this query, one judgment, even though it is on CPC scheme, it is very relevant. Judgment is of Mumbai ITAT, Kalpesh Synthetics versus Deputy CIT, 96 ITR Tribunal 690 Mumbai. It is on the 96 ITR Tribunal 690 Mumbai. In this judgment, the Honorable Tribunal has referred the Rule 11 into bracket I of the Central Processing Return Scheme, wherein it is clarified that the situs of the assessment unit or the assessing officer of the assessment unit is not important. The place at which the assess is located, it is the place which decides the High Court to be the jurisdictional High Court. So it is very important that where assess is located, and accordingly the jurisdictional High Court pronouncements are helpful to us. Thank you.
Mitish bhai, in lighter vein, I would just say that prior to Supreme Court judgment, this Provident Fund, Employee Provident Fund, we had seen some appeals where Provident Fund was being allowed following some other High Court judgments, even for Gujarat SSEs. And now I take up question number 16, that the SSE is a company, it had advanced loans to its sister companies, which were established for the purpose of promoting SSE's business, and interest on such loans was being offered to tax on accrual basis, on a year-to-year basis. Thereafter, the financial condition of the sister companies was bad, and the companies were shut down, and this SSE was forced to write off the interest amount and even the principal amount of loan. Now, whether this can be claimed as a deduction in the income tax return or not. Now friends, the answer would fall in two parts. As far as the write-off of interest is concerned, I think there should not be a problem in claiming it as a bad debt under section 36(1)(7) of the Act, because of the simple reason that The interest was being offered to tax on a year-to-year basis, on accrual basis, which was taxed by the department. So when a particular income is taxed and same subsequently if it is not realizable, it can be claimed as a bad debt by write-off in the accounts. The only problem that would arise was vis-a-vis the write-off of the principal amount of loan, whether that can be claimed as a deduction or not. Friends, here I would say that your case would stand or fall depending on the fact as to how you are able to establish the business connection between you and your sister concerns and the purpose for which the loan was given to the sister companies. If you are able to establish that the loans were given to set up the companies in order to see that you develop your business through those companies in that particular region or in that particular country if it is outside India, or that you have made exports to these companies and direct export or indirect export to be further given to the customers in the foreign countries. Meaning thereby that if you are able to establish commercial expediency and a business connection between you and these companies, then this write-off will be allowable as a business loss under section 28 of the Act. Friends, for this we have 2 or 3 very good judgments which throw light on such issue. One is a recent judgment of our tribunal, Ahmedabad Tribunal, in the case of Elecon Engineering Company Private Limited, ITA number 905/AHD/2017, wherein they have considered 3 or 4 case laws and allowed such write-off of the principal amount of loan as well. And I would like to give 2 or 3 other important judgments which can be usefully applied in such a situation. I'll just give the citations. Of course, they are old judgments, but still holding the field as far as this issue is concerned. One is the old judgment of Supreme Court in the case of Patnaik and Company, 27 Taxman, page 287. Then the celebrated judgment of Gujarat High Court in Abdul Razak and Company, 136 ITR, page 825. And again Gujarat High Court in the case of Pure Beverages Limited, 209 ITR, page 131. And we also have a recent Karnataka High Court judgment which considers all these judgments and has decided in favor of the SSE, which is 120 taxman.com, page 321, Ace Designers Limited. Thank you.
Question number 17. Here a search has taken place in case of a company, and during the course of search proceedings, loose sheets, Excel sheets, etc. have been found pertaining to an individual's name to an individual. Notice has come to be issued under section 153C in that individual's case on the basis of this seized material. Additions have also been come to made while completing the assessment on the basis of the seized material, and advice has been sought as to what could be the course of action. Now, before I begin, let me point out 2 important Supreme Court judgments which deal with the issue of what would be books of accounts. One is Union of India versus VC Shukla 1998 3 SCC 410, and the second is Common Cause a Registered Society versus Union of India 394 ITR 220 Supreme Court. What they have said is that what would denote in this VC Shukla case, if you all recall, Jain Hawala case was there and that Jain diaries were found, and they were Jain brothers and lot of politicians' names were there. In case of Common Cause, a search had taken place on 2 prominent industrial groups, Birla Group and one Sahara Group, and in again there loose papers and diaries and everything had been found which indicated payments which had been made to high-ranking politicians, and whether the issue was whether these can be a reliable evidence for the purpose of making investigations of people who are on high-ranking posts. Now, what does VC Shukla case deal with? Let us see that first before I come to the answer. They say that it is manifest that to make an entry relevant, therein it must be shown that it has been made in a book. That book is a book of account, and that book of account has been regularly kept in the course of business. So that entry, if it has to be made, and it has to have any kind of an evidentiary value, it should be in a book. That book, it should not be in a newspaper, it should be in a book. That book should form a part of your books of accounts, which are regularly maintained in the course of your business. Now, what is a book, they said? They said that it means a collection of sheets, paper or other material, whether blank, written or printed, fastened or bound together so as to form a material whole. Loose papers, sheets or scraps of paper cannot be termed as book, for they can be easily detached and replaced. So therefore, if there is a cluster of papers and you tie it with a string, that cannot be termed as a book, because you can immediately remove the paper and you can insert a paper. So that would not constitute a book of account. Common Cause also has defined book similarly. They have relied upon in the case of this VC Shukla case. Now, in light of this, what has been found in this case is certain type sheets of financial information and loose papers and diaries. So now, whether these constitute sufficient information for invoking 153C proceedings. Now, as you are all aware, what 153C proceedings are, that suppose there is a search which has taken place in the case of, say, A. During the course of search proceedings in the case of A, you come out with certain information, books of accounts, valuables, money, cash, which belongs to a third person, say C. So the AO of A, who is the search party, he will have to record his satisfaction and thereafter hand over all this material to the jurisdictional officer of the other party. The AO of that other party will again independently record his satisfaction and thereafter proceed against him and issue notice under section 153C, which is more or less thereafter the proceedings are para-party to 153A proceedings. Again, 6 years will be, you will have to go back and the same procedure will have to be followed. So for this, there has to be certain items which have to be found which belong to B. Now, whether in this case, the loose papers and diaries which have been found are only type sheets which cannot be termed as books of accounts. So therefore, whether this constitutes enough material to invoke 153C proceedings, that is the question. Very recently, Karnataka High Court in the case of Sunil Kumar Sharma versus DCIT 448 ITR 485 have taken a view that no, these kind of loose papers and Excel sheets by themselves, they do not constitute books of accounts and therefore 153C proceedings itself cannot be initiated. Leave alone whether additions can be made or not. We are on the first stage that whether 153C proceedings can be initiated. 448 ITR 485. So therefore, VC Shukla is 3 SCC 410. So therefore, on the basis of this decision, one can always make out an argument that no 153C proceedings can be initiated. Now coming to the assessment stage, of course, there are a host of other decisions that whether any corroborative material has been found during the course of search proceedings which indicate the actual undertaking of these transactions. You can always again make out an argument that these evidences and material have been found in the case of a third party. So 132.4 and 292 would apply in his case. They are not in my handwriting. That is a different issue altogether. But you can easily challenge, though of course the AO is never going to accept this. The AO is going to make an addition. But this judgment can definitely help in a big way in challenging the validity of 153C proceedings themselves. Thank you. Yes. Computer records, on digital data, what constitutes and what doesn't constitute, I do not have the citation presently, but a Chennai decision, some metal, very Keta metal or something, I don't recollect the name, they have made a detailed submission. Apart from that, there is another decision also in the case of GSM rice mills, which is a tribunal judgment. Please look into that. They have discussed threadbare, what is a pen drive, data, digital data, all those factors have been taken into consideration for deciding on the validity of these evidences. I can, if you can give me your email address or something, I will share those decisions with you at a later stage.
Thank you. Sir, I have one question. Sir, this 153C proceedings, Now I am taking up question number 18. Ms. Radha could not file return of income for AY 15-16, despite the fact that she had a total amount of tax deducted at source of rupees 45 lakh, while tax liability on her total income was only rupees 8 lakh, and thereby resulting to a refund of 37 lakh. Now, after a long period, in the month of November 2022, she filed an application under section 119 requesting to condone delay in filing return so that she can claim refund of excess TDS. Now the application was rejected, citing para 3 of CBDT circular number 9 2015, wherein it has been categorically written that no condonation for claim of refund or a claim of loss shall be entertained beyond the period of 6 years from the end of assessment year for which such application is made. Now question is whether she is left with any remedy for claiming this refund. I request all of you to note down a very recent judgment of Madras High Court, 133 taxman.com 228. It is R. Paneerselvam versus Principal Commissioner of Income Tax. I repeat, 133 taxman.com 228. I am reading certain operating part of the judgment, which is very vital for understanding. Here, para 13b, where Madras High Court observed that when we read section 237, that is all about claiming refund, it makes it clear that there is no limitation prescribed for filing a refund claim. That is what 13b para says. Para 16, again, Madras High Court noted that facts on record indicate that petitioner, being an income tax assessee, had failed to file return in time. The jurisdictional assessing officer ought to have issued notice under 148. If you are not filing return and huge TDS is lying in 26 years, then duty on officer was to issue notice under 148 on or before in that particular date they have given, as there would have been a prima facie presumption that income had escaped assessment for that assessment year. Because huge TDS is appearing in 26 years and return has not been filed, and prima facie it is a case of income escaping assessment, then AO ought to have issued notice under 148. Para 17, further, Honorable Madras High Court had made a detailed observation. If notice under 148 was issued to the petitioner, then proper assessment would have been completed, and such assessment would have finally determined whether petitioner was indeed liable for payment of tax or was entitled for refund. And para 20, that is what now concluding para, with a caution they have allowed, I am reading that, since law mandate a particular thing to be done in a particular manner, it was incumbent on the part of the judicial officer who ought to have issued notice under 148 of the Act to determine the tax liability of the petitioner. As this was not done, case deserved to be remitted back to the assessing officer to first finalize assessment within a period of 3 months. Now this is a very interesting, Madras High Court remanded matter back to the table of AO, saying that you should do assessment. And failure to issue notice under 148 cannot be prejudice to the prejudice of the petitioner if it is ultimately found that petitioner was entitled to a refund. But Madras High Court also given a warning to all of us. The liberty is given to the officer for failure to penalize petitioner for failure to file returns, and also to levy penalty and interest if any. That means only remedy in this case is that AO normally or 119 will get the rejection, because there is a CBDT circular that a refund claim cannot be entertained beyond the period of 6 years. But definitely we will get rejection. We have to file a writ, and we may get this kind of favor from the jurisdictional high court or writ high court. In this case, you have to file a writ, that is the remedy. And similar to this Madras High Court, there is a possibility that High Court may remand matter back to a table of AO to do assessment with a warning that he may be liable for penalty as well as interest. Thank you.
Yeah, question number 19 deals with the transfer pricing applicability. Section 92 of the Income Tax Act talks about the transfer pricing. Now, the transfer pricing definition goes like this: any international transaction between two associated enterprise, out of which one has to be non-resident. In that case, the international transaction has to be at an arm's length price. Now, here under this particular case study, there are three parts of the case studies. What it indicates that any international transaction between two associated enterprise. So, mind well, the concern is between two associated enterprise. Now, here the question is service receiver and service provider. Would they fall within the meaning of associated enterprise? That is the intention of the poser. So if they are not associated enterprise, then transfer pricing would not be applicable because three limb, any international transaction between two associated enterprise, out of which one has to be non-resident, then transfer pricing would be applicable and then arm's length principle would be deliberated. So here the part one of the poser says like this, there is a private limited company. The 100% shareholding and control and management of the private limited company is with the Indian resident. Now there is a company it's called PQR Incorporation in US. So PQR provides the technology support to XYZ Private Limited, and with the technology support, it is possible to manufacture the product by XYZ Private Limited. And therefore one would say that because of this technology, this product is possible to manufacture. Under this case study or under this particular portion, it is highlighted that the technology is being provided by the US company and XYZ Private Limited source all the raw material component from the domestic market or from anywhere, but they are from independent sources. So now the question is, would transfer pricing applicable? Because when you go to section 91 capital A, that is the definition of associated enterprise, there are 9 deeming provisions, and then we'll have to examine those provisions under certain situation. Though both the parties prima facie, what would happen under the transfer pricing? Both the associated enterprise should be connected either with the shareholding or with the board of directors compositions. Here it is neither shareholding nor board of director, that means management, but 92 capital A subsection 2 subsection G, what it indicates, when is a technology is being provided by non-resident and based on the technology the Indian manufacturers manufactures the product, it is completely dependent upon the technology. Without technology, it is not possible to manufacture the product. In that scenario, it will be considered as associated enterprise. So there is no holding, there is no control, there is no management, there is no director, common director, anything. But because of this special situation, because the technology, what company A manufacture is completely based on the technology which is supplied by BQR Incorporation US. Now the question would be, yes, it is associated enterprise, there is no international transaction. I'm not making any international transaction. When do you say international transaction? There are remittances. So prima facie, yes, they are associated enterprise. If there are no monetary transaction between the associated enterprise, transfer pricing would not be applicable. However, if there are monetary transaction between two associated enterprise, then one has to examine, one has to demonstrate the price of the international transaction is at the arm's length price. So part one, I'm not going forward with the method and the arm's length principle and everything, but answer to this question is very clear. No control, no management, but technology provider and exclusive manufacturing based on the technology. Part B is reverse. Part B, that XYZ Private Limited, they develop the technology. And the 100% supply of material and component from PQR is a reverse situation. Under Part 1, technology was provided and 100% sourced from the independent context by XYZ. Under Part B, technology is indigenous and 100% sourcing from PQR USA. Under this scenario also, under 92 capital 1 2 subsection H, indicate that this particular situation leads to the relationship of the associated enterprise, and therefore any international transaction between two entities, they are to be demonstrated at the arm's length principle, and therefore transfer pricing would be applicable. Going forward, XYZ Private Limited has a domestic technology. They source material from the indigenous, from the independent context. So PQR incorporation is not involved in any business scenario. XYZ as a technology, they procure the material, they manufacture a product, but then the PQR act as a sole distributor who decides the price, who purchase from XYZ, or even XYZ sales to third person, but based on the pricing guidelines which are decided by PQR, and under that scenario it is called an influence. So you have an influence of PQR, and based on the influence there is an export transaction, and therefore this will also be considered, or this particular transaction between XYZ and PQR is considered a transaction between associated enterprise. So again repeating that associated enterprise should be fine, but there has to be an international transaction. If it is international transaction between two associated enterprise, then we'll go to 92C to demonstrate the arm's length principle. Thank you very much.
Thank you. Now question number 20. Now this is also regarding the faceless appeal scheme. The crux of the query is that under the appeal proceedings, is there any remedy to have a physical hearing, especially when there is a rectification proceedings under section 154 of the Act? Friends, we all know that the faceless assessment scheme and now the faceless appeal scheme. Faceless appeal scheme is now implemented through notification dated 28/12/2021. If we read the para 7 of this scheme, this notification, it is very much clear that there is no such provision to approach the CIT appeals, because we don't know who is the CIT, but this is the faceless appeal proceedings. So the provisions under this scheme is that we have to make application to the National Faceless Appeal Center, and through National Faceless Appeal Center, the application will be moved to the CIT appeals under the automated system, and that CIT will decide, will dispose of the application for rectification under section 154 of the Act. So the difference between the faceless assessment scheme and the faceless appeal scheme is that under the faceless assessment scheme, after the passing of the assessment order, as we know, all the records of the assessee concerned is transferred to the jurisdictional AO. And then we can have the physical hearing, whether it may be the stay proceedings, it may be the recovery proceedings, it may be the rectification proceedings. So we can directly make application to the jurisdictional AO when there is rectification proceedings under section 154, but not in the appeal proceeding. So we have to rotate through the National Faceless Appeal Center. At the end of this scheme, we read that the personal hearing may be granted at the request of the assessee. So in my humble opinion, in rectification proceedings also, after getting the notice of hearing from the National Faceless Appeal Center, we can request for the personal hearing as provided under clause 12 of this scheme. So directly there is no provision, we have to rotate through National Faceless Appeal Center. Thank you.
This is question number 21. It is regarding deduction under section 54F of the Act from capital gains. The crux of the question is that the SSE sold a property, capital gains arose, long-term capital gain arose, purchased a new residential flat, but certain amount was invested prior to the due date of filing of return under section 139(1) of the Act. And most importantly, he did not park the remaining amount in the capital gain account scheme. But admittedly, the entire gain, net gain, was invested in construction, in purchase of the flat within the due date, within the time allowed under section 54F, that is 2 years, or if it is construction, then 3 years. Then whether the deduction under 54F can be denied on the ground that you have not opened the capital gain account scheme and therefore deduction is not available. Friends, at the outset, I must mention that there are divergent views on this issue. Bombay High Court is against us, whereas Karnataka High Court and Madras High Court are in our favor. But fortunately for us, Ahmedabad Tribunal is in our favor. They are following the judgments which are in favor of the SSE. And I would just like to give one Ahmedabad Tribunal judgment in the case of Anirudh Rinki Gandhi, 137 taxman.com, page 160, wherein they are following Karnataka High Court K. Ramchandra Rao and Madras High Court in the case of Motri Lakshmi. And they have distinguished the Mumbai Tribunal, the Bombay High Court, which is against us. And we also have another Ahmedabad Tribunal, which is in the case of Sanjay K. Rana, ITA number 996, AHD 2014. In this judgment, friends, they have reproduced all the judgments, the favorable judgments, the judgment which is against us, and ultimately applied the logic of vegetable products. We have the old decision of vegetable products, 88 ITR 192, wherein they say that if there are contradictory views available of High Court, then the principle is the one which is in favor of the SSE should be followed. Thank you. These are all judgments, but regarding, but we can use the logic of this judgment even for claiming subsequently, because within 3 years, if you are using it within 3 years, what I am trying to point out is the logic of this judgment can be used even in the amended provision by saying that the necessity of parking the funds in the capital gain account scheme is a procedural requirement. It is not mandatory. If even after the due date you are able to show that you have invested the entire net consideration in purchase of or construction of the residential property within the time of 2 years or 3 years, then still using the logic of this judgment, you can say that the deduction is available to you. This is talking of 139(4) return. There you can claim.
Well,
Earlier, yes. Be a problem of deemed dividend, because here what I am trying to say is that the question was regarding allowability of the claim as a business loss, and in any case you are showing the interest on the loan as a business interest, and it was being taxed by the department. So I don't think there should be a problem of deemed dividend. Only thing is that you have to prove the business nexus and the purpose for which the loan was given. If you are able to show that it was for business purpose, you have done business through these companies, then it is allowable under section 28, not 3617, but 28.
now I'll take up question number 22, which deals with certain addition on bogus purchase. During the course of scrutiny proceeding, SSC company purchase following list of documents are there to substantiate purchase. They provided everything almost, you can see purchase bill, transportation bills, even confirmation of the supplier, bank statements of the supplier, or even their bank statement evidencing payment is done through account pay check, VAT registration number of supplier, even VAT returns of supplier identity also proved by giving MO, AOA, PAN card, etc. Audit accounts of supplier, competitive trading results were also given of last 3 years. In short, whatever best possible with the SSC, he had submitted all the documents relating to purchase so that he can substantiate that my purchases are genuine. However, the AO disallowed the purchase, treating it as bogus on the basis of third-party information gathered by the investigation wing of department. The question is whether action of assessing officer is justified. Again, it depends on facts of each case, because if you look at the bogus purchase aspect, there are 3 possibilities. One, we have entire addition confirmed by even Gujarat High Court. One, we have percentage of profit, because you saved some percentage in procuring these goods, because you procured goods from X person and you procured bill from Y person. In that case, some percentage addition may also take place. And sometimes they delete the whatever addition done by assessing officer, depending upon the peculiar facts of that case. In this case, I think this is very near to, I'll take it, Supreme Court judgment, Commissioner of Income Tax versus Odeon Builders Private Limited, 266 taxman 461. I repeat, 266 taxman 461. In this case, this is a review petition filed by the department which was dismissed by the Supreme Court. 266 taxman 461. 266, 266 taxman. Name is ODEON, Odeon Builders Private Limited. ODEON. Now I am reading that para 3 of the Supreme Court judgment, where Supreme Court said that on going through the judgment of CIT, appeals, ITAT and High Court, we find that on merits, disallowance of 19 crore was based solely on third party information. The addition was based on third party information, which was not subjected to any further scrutiny by AO, and therefore CIT appeal allowed the appeal, stating, now I am reading the finding of CIT appeal, which was appealed by a tribunal, as well as High Court had not entertained question of law, being a substantial question of law, and Supreme Court dismissed review petition. I am reading that CIT appeal finding, which has been which has been noted in the Supreme Court judgment. The entire disallowance in this case is based on third party information gathered by the investigation wing of department, which have not been independently subjected to further verification by AO, who has not provided the copy of such statement to the appellant, thus denying opportunity of cross-examination to the appellant, who has prima facie discharged the initial burden of substantiating the purchase through various documentation, including purchase bill, transport bill, etc., etc. In view of the above discussion in totality, purchase made by the appellant from XYZ companies found to be acceptable, and consequent disallowance is directed to be deleted. So this was the finding of CIT appeal. Supreme Court further noted that ITAT relied on the same reasoning of CIT appeal and dismissed the appeal of revenue. High Court also affirmed the judgment of CIT and ITAT as a factual finding, and which has not shown to be perverse, and therefore dismissed the appeal, stating that no substantial question of law arises, and accordingly review petitions were dismissed by the Supreme Court as well of department. Now next question is, what could have been the penal consequences suppose addition was sustained by the higher court? So what can be the possibility? Now if you look at this addition towards bogus purchase, so somewhere it is observed that they make addition under even section 69C as well. Even I came across some judgment where confirmation from the supplier were required by the assessing officer, but they were not furnished, identity of supplier was not furnished. In that case, they have made an addition even under section 68 as well. So if this kind of addition would take place, 68, or sometimes there may be an excess stock found, there will be a possibility, and that is because of bogus purchase during survey kind of thing. Then if this kind of addition is there, 68, 69, 69AB, if you take it, then penalty would be leviable under section 271 AAC, which says that penalty would be 10% of tax payable under 115 BBE. And tax payable, we are aware of the rate is 60% at present under 115 BBE, then penalty would be 10% of that 60% would be 6%. But suppose addition would be other than that, straight away officer has established that this purchase is a bogus purchase just to reduce your profitability, and that he made that finding, and which finding finally get appealed at higher level, then penalty would be section 270A. That would be of underreporting of income, misreporting of income. This would be more of a case of misreporting of income. The penalty would be 200% of tax which has been on underreported income. Thank you.
I am taking up question number 23. The SSC is a cooperative society. Its claim of ATP2D was allowed in respect of interest received from cooperative bank in scrutiny assessment. But thereafter, the CIT is proposing for 263 action by saying that ATP2D is not available in respect of interest of cooperative bank in view of the decision of Karnataka High Court in Totgar's case. Now, whether 263 is justified or not. I know this is a disputable issue. Friends, at the outset, let me point out that apart from Totgar, we now have 3 Gujarat High Court judgments, 2 in favor and 1 a recent judgment, although it is for reopening of assessment under section 148, but there in one of the paragraphs some adverse observation is made by referring to Totgar. Of course, in that judgment, the earlier Gujarat High Court judgments are not mentioned because it was concerned with 148 and not on merits of the issue. So that judgment I am just pointing out because I have found this judgment quoted in 263 orders nowadays to help their 263 orders. It is the case of Cutlery Karyana Merchant Sahkari Sarafi Mandli Limited, which is reported in 140taxman.com, 140taxman.com, page 602, Gujarat High Court, which is on 148. 148 is confirmed by Gujarat High Court for this ATP2 deduction, and some adverse observations are made. But friends, as far as 263 is concerned, we have direct judgments in our favor, which I would just like to point out. The Ahmedabad Tribunal, in the case of Ekta Cooperative Credit Society, in ITA number 562/AHD/2019, 562/AHD/2019. This judgment dated 24th August 2022, wherein they have considered Totgar's an earlier Gujarat High Court judgment in our favor and ultimately held that since the assessing officer has taken a plausible view, at least 263 cannot be invoked by the department. Similar is the judgment of Surat Tribunal in the case of Bardoli Vibhag Gram Vikas Cooperative Credit Society in 127taxman.com, page 334. And also Mumbai Tribunal in 145taxman.com, page 415. 145taxman.com, page 415. And friends, most importantly, we have a very recent Jaipur Tribunal judgment, wherein they have considered this Gujarat High Court judgment of Cutlery Karyana Sahkari, and after considering the earlier Gujarat High Court Sabarkantha, etc. in our favor, they said that 263 cannot be invoked. Friends, I have thoroughly gone through this judgment. They have considered about 25 to 30 judgments on the issue, and ultimately they have held that 263 cannot be invoked by the department for the purpose of disallowing ATP2 deduction in respect of interest from cooperative bank. This judgment is Junjunu Karya Vikra Sahkari Samiti Limited, ITA number 150/Jaipur/2022. It is a judgment dated 15 December 2022. So friends, as far as 263 on ATP2D is concerned, in my humble opinion, the issue seems to be fairly settled that 263 is not tenable for this purpose. Friends, since this was the last question allotted to me, at the outset, I thank the organizers of this conference for inviting me to share my views with you, and I thank all of you for being here this evening and for a patient hearing. Thank you.
I'm taking up question number 24. Can addition be made under section 69C of the Act on account of bogus purchase when these purchases are duly accounted in my books? And books were audited, as well as my payment to the supplier was done through account pay check. So here the core question is, can 69C be invoked or not? Because many of the cases we find that they invoke section 69C. Now there is a direct judgment on that of Delhi High Court. That is 10taxman.com 138. I repeat, 10taxman.com 138, CIT versus Radhika Creation. I'm reading para 5, where Delhi High Court has first narrated that entire section 69C. I'm reading that part. insofar as first aspect of the matter is concerned, we find that Section 69C clearly stipulates that where in any financial year, SSC has incurred an expenditure and he offers no explanation about the source of such expenditure or part thereof, or explanation if it is offered by him is not in the opinion of EO satisfactory, then amount covered by such expenditure or part thereof may be deemed to be the income of the SSC for such financial year. So we are aware of Section 69, it is similar wording of Section 68. There is 69C, it says that SSC has incurred expenditure and he does not offer explanation, or explanation offered by him is not satisfactory about the source, then in that case that expenditure remain unexplained, which may be subject to addition under Section 69C. Now, High Court has written further, observation is very important, focus of Section 69C is on source of expenditure and not the authenticity of expenditure itself. So here the discussion is not of genuineness or ingenuineness so far as 69C is concerned. Now what is found in scrutiny proceeding is, if they find our purchase is ingenuine because of the statement recorded somewhere in investigation department of third party, then ingenuineness is the ground of reopening. But what officer does that at the time of completion of assessment, he makes an addition to Section 69C, where Delhi High Court says that focus of 69C is not authenticity of the expenditure, it is about the source. Now it is admitted position, now Delhi High Court has written that expenditure which was shown by the SSC is in its regular books of accounts, and it is because of this reason tribunal has observed that as the expenditure was accounted in regular books, source is obviously explained. Because it is a part of books, then source is bound to be explained. The provision of Section 69C in this case are not applicable because these expenditure are not unaccounted expenditure. The idea is Section 69C comes into picture when you are not able to explain source. Definitely that remains, that is the observation of tribunal, that remains an unaccounted expenditure. Only for that purpose Section 69C can be invoked. Now, I read very interesting judgment of Gujarat High Court on that also. You note down that 241 taxman 383. It is a matter pertaining to reopening actually. It was filed because of reopening was done. So it was, reopening was challenged under 148. Now in that there is an observation of Gujarat High Court. I am reading that part because in the reason recorded, you had mentioned Section 69C also. So what the Gujarat High Court had observed in para 12, I will read entire para. We are unable to appreciate the argument of the counsel for the revenue that disallowance towards bogus purchase would not qualify as business income and that it should be treated as income from other sources by applying provision of Section 69C of the Act. The revenue contention was that this is an income from other sources. Then Gujarat High Court says we are unable to understand this because you are going to propose disallowance towards bogus purchase. For that purpose you have done reopening, then it would be treated as business income. It cannot be termed as other sources income under Section 69C. This section pertains to unexplained expenditure and provides that, I am not repeating that part. Now Gujarat High Court had noted, present is not a case where SSC has incurred expenditure but failed to offer explanation about the source of such expenditure. The source in question was very much available since in the reason record itself, EO points out that purchases were made by banking channel. Therefore, Section 69C of the Act has no applicability. This is the observation of Gujarat High Court. So I think looking to these two judgment, Section 69C cannot be only, addition cannot be solely based on Section 69C or under Section 69C of the Act. So I think this is the last proposal allotted to me. I am first of all thankful to Dr. Keshi Mehta, who is a chief knee surgeon at Chandra Clinic as well as Apollo Hospital, who has sponsored the Bhagavad Gita. Many of you might have, I think, in the morning registration, you would have taken a benefit of that. So that is what he sponsored in the loving memory of his father, Chandrakant Mehta. And again, I am thankful to the organizer, that is All Gujarat Federation of Tax Consultants and IT Bar Association, for providing me an opportunity to share my views on the various interesting poses. And I'm again thankful to all of you for attending this. Since morning, I think you are taking this marathon. Thank you all. Thank you.
Now this is our last question to me. I first deal with the question. It is again on the procedural issues of the appeals pending before the Commissioner appeal. So how far the enablement window is useful for the appellant SSC? Actually, this is the actual word enablement of communication window. The difficulty is that after e-filing of the appeal, and unless the National Faceless Appeal Center allot the appeal number, we are not in a position to make any communication to the appellate authorities. And nowadays, you all are aware that lots of bundles of appeals are pending before the Commissioner of Appeals. There is no disposal. And particularly for the small matters, penalty matters, covered issue matters, we are waiting for the disposal of appeal, and on the other hand, we have to face the demand and the recovery. So recently, the National Faceless Appeal Center has issued sent bulk emails to all the appellants on their record that one window has been opened for the communication with the communication regarding the appeal pending before the first appellate authorities. So we have now not to wait for the first notice, because unless we reach earlier days, we have to wait for the first notice. And under that notice, we have appeal number and all this, then we can make the submissions. Now we can, using this window, we can make the submissions, we can make any communications through National Faceless Appeal Center. This is the remedial measure made by the center, and many of the professional colleagues are now resubmitting the documentary evidences and placing on the records of the appeal center. So disposal are now speed up, what I heard. But what I advise that even though under this window we are making the submissions again and again, but after receipt of the notice also, it is advisable to make again that submission, because there are chances that it may not be considered, because this is a technical system, technical error may occur. So this is the enablement of the window, which is very much useful. Particularly we can use it for the covered matter or the small matters, and we can get the speedy disposal of the appeal. Thank you very much. Mehul Bhai and both Mehul Bhai has expressed their thanks to the organizers. I, Mitish Modi, on behalf of Surat and Southern Gujarat, express sincere thanks to the President of the All Gujarat Federation of Tax Consultants, Hiren Bhai, the galaxy of the past presidents, the Income Tax Bar Association, Ahmedabad, Hiren Mehta. Really, I am very much thankful for giving me an opportunity. Bharat Bhai, Ravi Bhai, all are there. And I also enjoyed to share the dais with the learned people. This is the first time in Ahmedabad. I am the Brain Trust, one of the trustees. So once again, very much thank you for giving me patient hearing. Thank you very much.
Thank you, and thank the organizers in particular for inviting me to share my views. I'm also thankful to the participants. It's been a long day for all of you. And the last question is something which is going to disturb your dinner. The question is that a survey has taken place in a company, and the company has stated that my books of accounts are lying with my chartered accountant for the filing of the return of income. Now the income tax authorities want to survey the premises of the tax consultant. Can they undertake such action? Further, can the books of the tax consultant or that of his clients be inspected during the survey operation? Since this affects all of us, let me put this slightly in the correct perspective. 133A, survey operations can be taken by whom? One, there is a territorial jurisdiction of the AO. For instance, we are sitting in AMA, so Vastrapur is the territory. Say suppose ITO Ward 81 is the territorial jurisdictional officer, so he can undertake a survey of all the premises which fall within Vastrapur jurisdiction. That is one. Secondly, an AO may have a jurisdiction qua SSE. For instance, doctors are clubbed in one group, advocates and chartered accountants in another group. So therefore, he has the jurisdiction, say, over doctors. Now the doctor may have his clinic at Gomtipur, he may have it as SG Highway, he may have it at Amli Bhopal. There is no distinction. It is qua SSE, so that officer can survey Gomtipur as well as SG Highway as well as Amli Bhopal. So this is how and the third is that any income tax authority who has been delegated such power to conduct a survey by that officer who himself has the jurisdiction. So therefore, these are the three classes who can conduct, and this is the manner in which survey operations can be undertaken. Now there is an explanation to section 133A. What places? So they say that for the purpose of this subsection, a place where a business or profession is carried on shall also include any other place. Whether any business or profession is carried out therein or not, in which the person carrying on the business or profession states that any of his books of accounts or other documents or any part of his cash or stock or available article or thing relating to his business or profession is kept. So therefore now this company has stated that I have maintained my books of accounts and these are lying at my chartered accountant's place when they have come for survey operations. As per the explanation, definitely they can visit the office of the chartered accountant for the purpose of conducting the survey. The next question is whether can they touch the documents which are belonging to your other clients or your own documents. Now this is going to be a very vexed and a very difficult situation to confront, because what might happen is that they'll come to your office, say that we have undertaken a survey, he has intimated that the books of accounts are lying in your premises. So we'll tell him that these are these books of accounts, we are giving it to you. So he says, no, I have doubts. You may have some more books, I need to check. So he may check, he may not take, but then definitely he will check. Then he'll say that, okay, now we'll have to check your computer. What is the other data belonging to this SSC in your computer? So again, he may go through your computer, he may not take any backups, he may not do anything, not take any copies. But yes, you're definitely exposed. In the present scenario, we are witnessing that practice has also undergone a sea change. Now, everybody is offering packages. Okay, we'll do your bookkeeping, we'll do your direct taxes, we'll do your indirect taxes, we'll do your tax TDS compliances. So therefore, in this scenario, definitely the possibility is that he will have sent the data to you if you're doing his bookkeeping work also. If that be so the case, then you are getting more exposed to this fact. So the only way I see is that you'll have to earmark an area, okay, this is the office, here in this particular portion of the office, we are doing bookkeeping work. So even if he comes, he goes only to that area, doesn't come to the other areas, that kind of restriction can be done. But otherwise, yes, he can definitely come if the person has informed that the books of accounts are lying with you for tax purposes or any other purposes. So I think certain precautions need to be taken if you are doing or offering services on a package basis where the entire spectrum of professional services are being offered. Thank you once again. Thank you very much. Thank you. The entire rationale and principle has been laid down in UK Mahapatra and Company versus ITO 308 ITR 133 Orissa. 308 ITR 133 UK Mahapatra and Company. 133, yes.
We thank all our dignitaries for the brainstorming and the insightful session. The sight of most of the participants here noting down what was being discussed aptly proves it was an ideal brainstorming session. I'm sure the session was fruitful for each one present here. This leads us to the end of the last session of day 1 of the 2-day Tax Conclave 2023. All the dignitaries on the dais are now requested to move ahead for a group photo session.